Hi there folks, it's James Marley here, co-founder at Livewire Markets. Reporting season is just about done and dusted, and I'm joined by Chris Stott, who's the Chief Investment Officer of 1851 Capital, a small cap guru. We're going to be talking about some of the big moves in reporting season, what he took away from it, and the fund's also just gone through its 5-year benchmark, so we'll have a chat about some of the stocks that have done the heavy lifting over the years, and maybe a few of the new ideas that Chris has uncovered from the market. Chris, thanks for coming to Livewire, good to have you here.
Great to be here as always, James.
Well, as I said, reporting season, big exhale for you. It's just about done and dusted. What did you take out of it? What were sort of some of the key themes that caught your eye?
Probably the most volatile reporting season I can remember in 20 years. The share price moves on the back of results have been quite extreme this reporting season. This is in the small cap end of town. We're talking about outside the ASX 100 here. Propensity for bad news is just extraordinary in terms of people's abilities to shoot from the hip and sell and not worry about it. You know, intraday swings in share prices, such as Integral Diagnostics, which is a stock we luckily didn't own, but it fell. It had a slight earnings miss, and the stock was down 35% at one stage on the day of its result, only to finish down 12. So it had an over a 20% intraday swing, which is extraordinary volatility, which creates opportunities for people that are tapped into that. But volatility was one theme. I think the other theme that came across strongly out of companies that we've spoken to. We've probably met with over 100 companies in the last 3 weeks. We've got more to come in the next few weeks. It was just cost growth. A lot of companies got caught out on costs, right, particularly labour and rents. Whilst across the board revenue lines held up reasonably well, in some cases exceeded expectations. Generally, companies that missed expectations missed it because costs just grew too quickly.
That inflationary pulse is taking a while to.
It is. It's taking a while to wash through the system, as you say, James. And so, particularly, say the mining services part of the economy, like there's still enormous labour pressures, shortages, and so although wages growth has abated, but it's still putting pressure on margins.
Now I know you're a stock specific kind of guy, and not necessarily at the index, but just to get a read on your feeling more broadly, where do you think markets go from here, and what needs to happen for them if they want to move higher, if to take them higher?
We're positively disposed to the outlook for equities still. I mean, we have had a good run, globally. Particularly the US market has outperformed Australia quite strongly, and more so the small cap market here in Australia over the last 5 years, which we'll touch on a little bit later. But we've had the first rate cut this month. That's a positive sign, obviously, for the economy. The particular call out here is the small cap end of the market in Australia is heavily exposed to consumer discretionary companies. So typically what we've found in our experience is the small cap market tends to outperform when rates are coming down and the economy is growing at above trend rates. And that's certainly a period which we believe we're entering into over the next few years on the back of a few more interest rate cuts to really spark economic growth to be above trend.
And is that your expectation on rates?
Look, it is, yeah. Look, I think you'll see more rate cuts as we go through this year. And you've seen globally, we've had more rate cuts in Australia, but they hiked more than we did, generally speaking. So, the expectation is the next rate cut will be in May. I think the RBA have done a terrific job in the last few years in terms of monetary policy and communicating effectively with the market. So we are expecting interest rates to fall further over the remainder of 2025, which should be a spark for economic growth and for earnings growth for the companies that we look at.
Okay, let's dive into that small cap space. More recently, at the index level, it's been a bit subdued, and there's been some patches in there that have been actually really, really tough. More broadly, I guess the history of small caps is probably a bit more buoyant. People, have gone to that part of the market for growth, outsized returns. Why has it been tough in the past 3, 4, 5 years? Yeah,
it's interesting. So we've been going now for over 5 years in 51 Capital, and in our first 5 years, the Small Ordinaries benchmark in Australia has delivered a measly return, let's say, of 4% per annum. That's the worst 5-year block we've had, going back for many, many decades. For the 30 years before we launched the fund, so this is 30 years going back from 2020 and back from there, the Small Ords produced a return of 10% per annum. So the small caps, as you say, James, have materially underperformed over the last 5 years. And why is that? Typically, as I said earlier, you tend to find that the small caps will perform better in loosening interest rate cycles rather than hiking like we've had over the bulk of this period when you put COVID to one side. That's certainly put a lot of pressure on company earnings. We haven't seen any material earnings growth from some of these companies for a number of years now. But we do believe as we go forward, as I said earlier, with rates coming down and falling, that provides a much better setup for the small cap market over the medium term.
What about the structure of the market? So things like ETFs, super funds, the need for liquidity, which is only available in those larger companies. Is that a factor now that the smaller part of the market is just less appealing or less viable for some of these other players?
Yeah, look, it's a big factor. Look, if you go back comparing, say, 10 to 20 years ago, there's obviously a lot more passive money in Australia right now than there was. So versus 10 years ago, right now about 23% of the market is made up by passive money. So what I say is like ETFs and the like, versus 11% 10 years ago. So that is a growing piece of the pie, not only in Australia, but around the world. And that will likely continue. Plus you've got a more concentrated group of fund managers these days with a lot of money that's been internalised into large super funds. They typically run the money themselves these days, hire their own teams, as opposed to outsourcing to fund managers like they've done historically. So that creates less liquidity, more volatility. So it's a very different backdrop. And what we think it's done is it's the micro cap end of the market. So now I'm talking about companies that are sub 300 million in market cap here in Australia have been really weak for the last 3 to 5 years. And I think some of those factors are the reasons behind that. So we are seeing some good opportunities down there right now as a result. But certainly the microcap space to us looks the most hated, the least cared about for the last 10 years right now.
You mentioned interest rates being a bit of a tailwind. Is that enough of a catalyst to get more people down looking at that part of the market so you get that price discovery?
Not a singular rate cut like we've had, absolutely not. No, you need a succession, you need a number of rate cuts to come through. Particularly, as you say, James, a lot of those large cap investors that have got the mandate to invest in small caps can come down into small caps, and they haven't been for a number of years, and that's been the right call. But you probably need to see a few more rate cuts for that trigger to go off, we believe, and that should certainly underwrite the performance of the small cap sector over time.
As I mentioned in the introduction, you've just gone through 5 years with 1851 Capital, which is the firm that you launched post your career at Wilson Asset Management. I've seen the latest Mercer Fund Manager Rankings report. You came number 3. I know you're a competitive beast. You're probably not satisfied with that.
No.
But if you're to take that 5 years ago and say, hey, this is where you'd be, would you have taken it?
Oh, of course you would. Yeah, I think the team have done a terrific job in the first 5 years, I think, and we've executed on what we said we were going to do. So it's pleasing to be able to deliver strong returns for our investors and do what we said we were going to do, as I said. So we don't take anything for granted. That's the last 5 years, the old cliche. It's all about, you wake up and it's a new day tomorrow, and it really is. I mean, the end of
I'm feeling like I'm on the side of a sports ground.
Yeah, there's a little bit of that.
Keep turning up for each other.
That's right. Pat each other on the back, so you go about it again. But no, certainly one thing I've learnt doing this for the period I have is you can't be complacent. Keep your feet on the ground, stay humble, because the minute you get ahead of yourself in this game, you're going to get smacked with something quite quickly. So the market is a great humbler over time. So we've got a great team to execute on the next 5 years, and we're very focused on that right now.
Okay, we're going to let you relive some of the things that have worked for a moment, and then we'll work out a few new ideas. But over that period of 5 years, are there a couple of names that have really been big contributors and helped you deliver the returns that you've achieved?
Yeah, so there's a couple that I'd call out there, James. There's a lot of losers too, by the way, but if you want to ask about the good ones, that's
Love
good
to hear
too.
the ones.
So Unity Wireless was probably one of our biggest contributors over the first 5 years. So they've been taken over now, but they were in the telecommunications sector. Yep. Mick Simmons, great CEO, executed to strategy, got the business sold. So that was a big contributor. So that got taken over a couple of years ago now. So that was a big contributor in our first few years. 2 other stocks that I'd call out that we still own today are Pinnacle, and Tuas, TUA, in the telecommunications space as well. So that's David Teo's new business. Well, I'd say new, it's been going for a number of yeyears now, but essentially the TPG of Singapore. So that one's been a big contributor to the fund as well, and we continue to hold both Pinnacle and Tuas. We like them. Pinnacle are experiencing really rapid inflows right now across a number of their affiliates. Ian McCoon and his team have done a terrific job in terms of executing and growing in a really, really tricky market over the last 3 years.
They've sort of gone against the trend in the active space, really, haven't they?
They've done a great job diversifying away from equities, where they were quite heavy 10 years ago. So Antipodes, Firetrail, some of these successful affiliates. But as a whole, Pinnacle were overweight to Australian equities. So they've done a great job diversifying away into more private markets, private credit and the like. So that's certainly...
private equity now as
well.
well.
Yeah, exactly. And that's going well for them with 5V. So Pinnacle continue to go from strength to strength and reported a really strong result again. this reporting season just gone and beat market's expectations by about 10%. And Tuas is another one we continue to hold. We like that one. Really strong management team. We've made a lot of money with TPG over the years under David's stewardship as a major shareholder. He's a major shareholder again here, so it looks a similar setup to us. So it was an easy one to buy into in the early days, and we continue to like it. They're experiencing rapid growth up there in their markets, taking significant market share, undercutting the competition on price, and that will continue to drive their growth going forward in our view.
And those two positions, Pinnacle, Tuas, you said they've been big contributors. Are they big positions within the portfolio today?
Yeah, they're both in our top 10. Right. So they are, good, solid holdings for us, and they can, around that 2 to 3% portfolio weight mark.
Okay. Another name that is big in the fund, having had a look at the reports, Generation Development. It's had a great run. Could you take me inside the thesis on this stock, because it's obviously had decent sized capital raising to fund an acquisition. Why do you like it?
Yeah, look, it's interesting. So run by Grant Hackett, ex-Olympian, one of the most motivated CEOs I've ever met, and he's done a terrific job in terms of executing. So Generation Life, primarily investment bond space, but more recently they've moved into the managed account space via that full acquisition of Lonsec, and more recently Evidentia, which they raised money for only a few weeks ago, and that's been the major reason why the share price has jumped in more recent times. But certainly, that company's been a good long-term hold for us, since inception as well, at 1851 capital. We think they're in a great position going forward. The market cap now is at just under 2 billion. It will likely enter the ASX 200 in June, we believe, so that normally is a pretty significant catalyst for the passive flows to be forced to buy a position into the company. And the growth that managed account space is experiencing, it's definitely a structural shift. And we believe over the next 5 to 10 years, they'll make up a very large part of the market. They save advisors a lot of time from a paperwork compliance standpoint, and potentially access to products at lower fees. So we believe that all those factors put together provide a really strong backup for Grant and his team to execute on their strategy for the next 5 years. So that remains our top holding in the portfolio.
We've seen a couple of stocks related to the industry that you work in. So if we look at the platforms like Netwealth and Hub, have had these incredibly long runways. They've executed very well, and now it appears that the runways are just continuing to grow. With this managed accounts area, I hear a lot of talk about it from people within the industry and the appeal for advisors. What's your sense on the size of that opportunity? It's
very difficult to put a number on, James, immediately, but it's going to be a multi-billion-dollar product, hundreds of billions potentially over the next 5 to 10 years. And as I say, the advisors are speaking with their feet right now. You can see it. And we've spoken to a few of them and interviewed some of them, and just to understand their logic and the reasons why they like the products so much. So, a lot of it was brought about by the various regulatory changes that came into the market over the last 5 or 10 years. And so essentially, as a financial advisor, there's a lot more red tape than what there was 20 years ago. And so anything that saves an advisor time and energy is a big tick for them.
We talked about a couple of stocks that are not necessarily under the radar. They've done well. You mentioned you can go down to some smaller parts of the market. Maybe share with us an idea that's overlooked, hasn't had that strong run, where you think there's a little kernel of an idea and a catalyst to take it on.
It's funny you say kernel, because the stock I had is Collins Foods, who own the KFC franchises, or some of the KFC franchises in Australia. Well, that's a good point, James. So look, we think the stock hasn't had a run at all, as you say. It's been forgotten about a bit. They've had some leadership changes with the business more recently, which we see as a positive thing. But they've also gone through a period of below trend growth in the KFC stores over the last 12 to 18 months for various reasons. You see the data points that have come out more recently from Yum in the US, and Restaurant Brands which is listed over in New Zealand. To us, that tells us that they're certainly tracking a little bit better than what the market's expectations are in the very, very short term. Over the medium to longer term, the new management team, we believe, will come out and with a strategic review of the business, as a new management team does as they enter a business, and articulate the go-forward strategy for Collins Foods. And so, they've got operations over in Holland. They've got the Taco Bell franchise in Australia, which hasn't worked for them. So there's got to be question marks around what they do with those particular parts of the business. But at the end of the day, I think it's on a P of 16, which is the cheapest it's been for many, many years. The stock hasn't run at all, as I say. So they're an out-of-cycle reporter, so they'll report their results in May or June of this year. But we think that certainly there's some runway there for good share price gains. It's probably halved off its highs in the last 12 or 18 months, so we think it looks good here.
Okay, very good. Now, we've talked about a couple of stocks you own, a couple of stocks you've been adding. We don't talk as much about the sell process, and perhaps in the context of the 5 years that you've been running your own fund, what have you learned about becoming a good seller? What are your rules for selling? And maybe bring it to life with an example for us.
Yeah, good. So, I mean, it's a good question, and it's something we're always working on. We're not normally good sellers. We normally sell things too early. And so we're constantly reviewing our sell disciplines. We sit down as a team quarterly, go through our attribution. What could we have done better? What have we done well? What have we not done well? And selling is a big part of that. And so one example that I'd call out here, which was an initial holding for us in the fund, was Frontier Digital Ventures, run by a really high quality operator, Sean DeGorio, ex-REA, XI Property Group. We made good money out of those two stocks years ago, and we thought we'll go again with him at FDV, which was essentially the realestate.com but for emerging markets. So primarily real estate portals. Unfortunately for them, and we did go in with our eyes wide open, things that are outside of Sean's control, such as geopolitical risks in particular, with their major asset being in Pakistan, and the issues they've had over there in the last 3 years has really dampened growth. So we did sell out of our position of FDV probably about a year ago now at about a 40 to 50% loss. And so it was a really tough decision to make because we were sitting on a reasonable loss. That shares had underperformed, but they've since halved again since we sold. So that is an example of one that has worked for us, if I dare I say it. I mean, we have lost money, which we don't like doing. We were very alert towards the end there of what the risks, and it didn't look like that they were going to abate anytime soon, which has proven to be the case. Wishing Sean and the team very well. They'll continue to execute, but just factors outside of their control have really got them.
How much cash are you holding at the moment, and is that a higher or lower level than what the fund has averaged over the time?
Just over 10%, which is above our 7% average we've had for the first 5 years. I wouldn't say there's anything to that, to be honest, James. We are, at the moment, we do turn our portfolio over quite a lot in reporting season, so we're moving out of some of our winners into new stocks, and we're going through that process right now. So I'd expect that cash will trend back down towards the 5 to 7% mark over the next few weeks as we continue to deploy into new positions we've started buying.
That 7% number, if I'm correct, is quite a bit lower than the long-term cash holdings where you kind of learnt your trade at Wilson Asset Management. Why the change in the strategy, given that was kind of what you were brought up on? Yeah,
it's a good question. I think clearly the Wilson Asset Management strategy is slightly different to us. The default position is to stay in cash, and so that strategy has worked very successfully over more than 20 years now. So in terms of our philosophy with how we run the money at 1851 Capital, our philosophy is if people are invested in the fund to get exposure to small caps, that's what they want. If they want to be in cash, they'll decide that for themselves. So typically what we do focus on, though, in addition to our cash weightings, James, is making sure that we've got as much liquidity within our existing stocks and positions in the portfolio. So there's no unlisted holdings. We've been through the GFC, we've been through COVID. When markets get choppy and volatile, you want to have cash on the sidelines ready to go. And so it's always healthy to have a little bit of cash for those reasons, and also for deals that come up, whether it be IPOs, capital raisings, where you've got to make quick decisions and take advantage of opportunities that may arise.
So that liquidity, I guess that's one of the troubles of the small cap space. So you have to hold some core positions in larger cap stocks for that reason?
No, we'll hold things that we believe are fairly valued and will go up. And that's primarily a big reason why we soft closed the fund to new investors back in August of 2021, the major differentiating factor with our business is that we are keeping a cap on our funds under management. And our belief is as the fund grows in small caps, Australian small caps, the harder it is to outperform, and therefore liquidity becomes a bigger issue. Right. So for us, we don't think at our size right now that it's impeding our ability to outperform, but if it did, we believe that would be over the $600 million mark. We're at $530 million today. We'd potentially bring in more restrictions on our fund, albeit returns of capital or limiting people's ability to reinvest the distributions. Right. So there's some of the things that we're considering over the next couple of years, and we won't be afraid to implement them to make sure we can give ourselves the best possible chance to deliver strong returns to investors. Yeah.
Well, as you say, you've got to keep your head down. You're at 530 now, we're not at 600 yet. So cross that bridge when you come to it, hey?
That's right. Yeah, hopefully we get there and markets remain conducive to strong returns. We believe they will, and we think we've got the team and the process to continue to execute.
Good stuff. Well, Chris, I know it's been a busy time. You've put on a brave face. You're looking pretty fresh for someone that's just been
I appreciate that. I don't
through
feel
reporting
fresh.
season,
Yeah.
through a few potholes, no doubt.
That's right.
But great to catch up. Well done 5 years, and thanks
Thank
for
you.
sharing a few ideas with us today.
Thanks, James. Good to chat as always.
Ladies and gentlemen, I hope you enjoyed that chat with Chris Stott, Chief Investment Officer at Small Cap Specialist 1851 Capital. Remember, if you enjoy this video, check out our YouTube channel. There's plenty of content there.